a lot of non-specific information, and we're trying to, figure out what's going on here based on what might be going on in neighboring communities. So it's very difficult when you're in a tertiary market to find really good information. Again, that's why that local knowledge becomes really important. What are the property types in the distressed asset market? Well, the fact of the matter is, it's all property types. This chart represents the percentage of the marketplace that is being represented by distressed asset sales. Leading the way is hospitality, multifamily, office, retail, industrial, all sitting down here, but all clearly, with the exception of the hospitality, which tends to jump up and down a lot, on an uptick. So more and more of the transactions that occur every quarter are transactions that come from the distressed marketplace. Foreclosures, REO, non-performing notes. This is Glenn Mueller's same real estate curve, demand curve. However, now it's rather than location, these are property types. And you can see as well, the property types that are in the recovery period is basically all of them. So in the general sense, in the non-specific sense, every single property type in the US is sitting over here in phase one recovery. This is a 15 to 20 year cycle that you're looking at here. And so, figure out how many years it is till you get to 8 based on where products are today in terms of building. And I've got some slides to show that, in fact, unlike the last time we did this, we're in pretty good shape about absorption because there haven't been a lot of new buildings in the last couple of years, which will help us out of this recovery, I think. So what are the price breaks? Where are the distressed assets? What are the prices that they're being sold at? This represents office sales and industrial sales in the distressed marketplace. And you can see the dark blue on the far right of each represents the 2010 sales. And so you can see in office and industrial, what you may not be able to, whoops, sorry about that. What you may not be able to read is that this is the under $5 million category, this blue bar and this blue bar. So the bulk of the transactions that are taking place are in the under $5 million market. So they're not taking place at the higher levels, and there's reasons for that that I'll go into in a little bit. If you take the complete national marketplace and look at that, you see that the bulk of the transactions, the dark blue, are all now in the less than $10 million category. So this is where the transactions are taking place in terms of volume of transactions. By the way, in that previous slide, the office and industrial transactions, there were 1,200 of them in 2010. Divide that by 50 states and figure out how much per state that is. So there's not a lot going on. Now, I don't need to tell anybody out here about that. But, there's a limited amount of commission dollars to be made in this marketplace. But there is an unlimited amount of fee dollars to be made in this marketplace to help people value their assets, to help people work out an issue with a lender, to help people restructure their debt, to help people reposition their properties. And you get paid to do that, not as a carrot, but as a fee. And that's really, unless, that's really where the money is in this business and will be for the next 3, 4, 5 years. Will you get a hit or two on the way? Absolutely you will. But these markets are designed for the Sam Zells of the world. Distressed markets are designed for the really, really, really top-level cash buyers who are just waiting for someone to finally just give up and let the stuff go. But for the rest of us, we make a lot of money in bringing our expertise to the table, helping people resolve issues. So who are the players in the market? Well, the very rich, of course, are one of them. But You need to get to this list. Right? There's the investors that are creating this pretty serious bid-ask gap that we still have in the marketplace. We all have them. Our goal, of course, is to create more realistic expectations. You do that with data. Owners. Every owner of every property in the United States today has a problem. They have two kinds of problems. They have the current perception of the income stream that they're producing. And since many of them bought those properties in 2005 and 6 and 7, they're all looking at mortgages being restruck in a more restrictive lending environment. So they all have problems, no matter how good their properties are. So, you know, you get with your clients, talk to your clients about their problems, see what you can do to help them out. They have the problems. The lenders, they're players in the marketplace because they too have problems. They have budget issues. They are trying to decide right now, you know, it's expensive to foreclose. It's expensive to have REO. I think Cotton will be the very first one to tell you that he doesn't know a lot about real estate. He knows a lot about banking. So bankers shouldn't be in the business, but suddenly they are. They're dealing with large quantities of assets that they don't know what to do with. Well, notes that will become assets that they're not trained to deal with. Special servicers. In addition to the lenders, right, we've got our balance sheet lenders, our national commercial banks, and then we have the CMBS market, the other shoe that everyone talks about dropping in the commercial marketplace today. Special services represent the CMBS marketplace. They are the bankers for all of these commercial mortgage-backed securities that were sold into the marketplace that people are now trying to buy and sell. What's happening to most of them is their debt is being restructured. But there's a place for all of us in that process as well. And then, here's people that you need to know. Receivers. Receivers are the folks that are put in place to take care of the building when the lender and the owner are not getting along and the lender wants protection for the property. So they ask the court to name a receiver. The receiver then takes over the property and handles it as though they were the owner, taking care of the checks, the maintenance, et cetera. Receivers are typically appointed by the court through attorneys. So that's where your connections are to this business. Receivers tend, in many ways and many times, to actually be asset managers or property management companies. So get to your IRM buddies. If you're a CCIM, if you're a transaction person, you know, get to the people that are handling the property deals, put together partnerships, go to the people with the problems, and suggest that between you, or with all efforts, you have what it takes to solve the problems. Loan advisors. There's a whole slew of people out there called loan advisors that are advising the banks on what to do with their non-performing notes. Sell them, keep them, foreclose, what to do. Those loan advisors are another way for you to get in because they all still need to do what? They still need to understand the underlying asset. Because that's the key. Is this asset something that can be repositioned? Property and government agencies, of course, FDIC, FHA, GSEs, Freddie Mac, Fannie Mae, all of them involved in it. How many people have been to FDIC.gov to look at the assets that are available for sale on the site? Pretty slim, right? Pretty slim. They're there, but it's pretty slim. And if you get into who's got them listed for sale, if you're not buying the notes, you're going to go through CBRE or Prescient anyway. So, you know, it's a bit of an issue, but you should, since only a few of you have been there, I would really urge you to go spend 20 minutes on the FDIC.gov site, look at the failed banks, look at the real estate for sale, look at the kinds of assets and notes that are being sold on that site. Get some idea for how much activity is going on there because there's a lot of activity. But again, when you break it down to Alabama, there's not a lot offered for sale. Balance sheet lenders, CMBS people, balance sheet lenders, REO, balance sheet lenders, NPN, non-performing notes. REO is real estate. It's regulated by every state. If you have a real estate license, you can represent people in the sale or the purchase of REO properties. Non-performing notes, not regulated. So it doesn't matter who you are. You can work and help buy and sell non-performing notes. There's no licensing, there's no regulations, there's no requirements. So, and it is what banks have more than they have REO. So remember that there's a whole slew of non-performing notes that need help. By the way, what's the trouble with non-performing notes? Well, depending on what state you're in, there could be a redemption period. And foreclosure is expensive. So if you buy a note, you need to be prepared to have a slim income stream while the mortgage payments are being made, because you do get a return there. But you also have to understand that for the next year after you take possession of a foreclosed property, at least in Alabama, the owner of that property can come back and take it back from you at any time. So it can be a bit of a confusing issue. Who's supplying what little acquisition financing we've got out there? The orange are international and national sized banks. Yellow is assumed debt. And it's very interesting to see 2009 was a very active year for loan assumptions. And that's now beginning to dwindle. And it's beginning to dwindle because CMBS is finally starting to get back into the marketplace and supply a little bit of financing to get some deals done. It's still mostly about regional, local, and national commercial banks, however. How big is the market? A couple of slides to look at in terms of how big this market really is. I'm going to use a pointer here. This is 2010 to date. So far, transaction volume by property type in the United States, $66 billion. Well, that's great. That's 80% more than 2009. However, it is just about exactly the same volume that was done after the dot-com boom bust. So, you know, good news, bad news. You know, it's a small market. 2007, we did over $500 billion in commercial real estate sales. 2010, $66 billion. So long way to go to get back to what people are trying to say was normal, which was the 2007 activity. Quarterly volume and trends, apartment, industrial, office, and retail. What you're seeing here, we all remember 2007, lots of good things going on, and then the decline in 2009. And if you start now tracking the end of 2009 through today in 2010, there's actually a quarter-to-quarter increase here over 8 quarters of 50% increase in volume of transactions. However, that's a 60% decline with that increase over where we were in the top quarter in 2007. So good news, bad news, right? Are we starting to see some trends here? Could very well be, but we're seeing it in baby steps. We're not seeing floodgates open. How big is it actually? Well, according to Marcus and Millichap, it's $186 billion, which includes office, apartment, development, hotel, retail, and industrial properties. With office leading the way typically in terms of the value, and apartments leading the way in terms of number of properties sold. Again, the biggest amount of work being done in those 4 major property types. So $186 billion is a pretty good-sized market. This is foreclosed properties, bankruptcies, and lender REO only. It does not account for any of the upcoming mortgages that could add to this particular marketplace. And how big is that marketplace? Well, there's approximately outstanding in the United States today $2.4 trillion in debt waiting to mature. That debt resides primarily in commercial banks and in the CMBS market, waiting to mature.